Brad Williams, Frugal Finance. How about changing the beta of a portfolio? I introduced this earlier under a different example. How about we look at it in terms of changing the beta of the portfolio here? Notice the difference, or recognize the difference, if there is any, between that first example and this second example. That being said, investment managers often adjust the CAPM betas of their portfolio in anticipation of bull and bear markets. When expecting a bull market, a manager might increase the beta of the portfolio to capitalize on the expected rise in stock prices. Conversely, if a bear market seems likely, the manager might decrease the beta of a stock portfolio as a defensive measure. Think about this for a minute. Why? Remember, there's that adjustment, if you will. Your portfolio will move in relationship to the beta. So perhaps if you are very aggressive and you have a beta as a 2.0 or a 2 beta, and you anticipate a possible bear market, maybe adjust that so it's not as aggressive. Given the relatively low transaction costs in the stock market, this strategy can be advantageous. The adjustments involve selling some high beta stocks and using the proceeds to buy low beta stocks. That's one way of doing it. Conversely, if a bear market seems likely, the manager might decrease the beta of a stock portfolio as a defensive measure. This adjustment involves selling some high beta stocks and using the proceeds to buy low beta stocks. The investment manager can utilize stock index futures to create a combined stock futures portfolio with the desired response to market conditions. In this context, we explore techniques for altering the risk of a portfolio using a stock index future. In the CAPM framework, all risk can be categorized as either systematic or unsystematic. Systematic risk pertains to general market movements and affect all investments, while unsystematic risk is specific to a particular investment or group of investments. Diversification can almost entirely eliminate unsystematic risk from a portfolio, leaving only unavoidable systematic risk. Studies demonstrate that a randomly selected portfolio of 20 stocks will have minimal unsystematic risk. Thus, we focus on portfolios that are well diversified and consequently have no unsystematic risk. By combining a stock portfolio with systematic risk only with risk minimizing short positions in stock index futures, a combined stock futures portfolio with zero systematic risk can be created. You get that? By combining a stock portfolio with systematic risk only with risk minimizing short positions in stock index futures. So we're being a little creative here. According to CAPM, such a portfolio should earn the risk-free rate of interest. Instead of fully eliminating systematic risk through hedging, it is possible to hedge only a portion of the systematic risk to reduce it. Similarly, an investment manager can use stock index futures to change the systematic risk of a portfolio. A risk minimizing hedge involves matching a long position in stocks with a short position in stock index futures to create a portfolio whose value remains stable despite fluctuations in the market. To reduce but not eliminate systematic risk, an investment manager could sell some futures, but not the full amount indicated by the risk minimizing hedge. Let's say your hedge ratio is 100, your portfolio is 1.5, maybe you only want to hedge 60% of that. Oh, I bet you there's a formula that's going to tell us how to do it. For instance, to eliminate half the systematic risk, the manager could sell half the number of contracts specified by the risk minimizing hedge. As a result, the combined stock futures position would possess a level of systematic risk equal to half of the stock portfolio's risk. It's also possible to trade stock index futures to increase the systematic risk of a stock portfolio. If a trader buys a stock index future, he increases his systematic risk. Therefore, an investment manager holds a stock portfolio and buys stock index future. The resulting stock futures position has more risk. In other words, you have a portfolio, you buy the index, well, guess what? It sounds like you're doubling up your risk. For example, assuming an investment manager buys, instead of selling the risk minimizing number of stock index future, instead of eliminating the systematic risk, the resulting stock long position, should have twice the systematic risk of the original portfolio. We can clarify this principle by considering the same data we used to illustrate the risk minimizing hedge. In that example, the risk minimizing futures position was to sell 52 contracts. Selling 52 contracts to create a stock futures position with zero systematic risk. By selling just 26 contracts, the investment manager could cut the systematic risk of the original portfolio in half. I guess you'd want to test this. Also, by buying 52 contracts, the resulting stock futures position would have twice the systematic risk of the original portfolio. Figure 8.4 shows the price path of the two portfolios of the 60-day hedging period from November 28th to February 22nd. First, the graph shows unhedged portfolio. Its value begins at 10 million and terminates at 9.6 with change. Over this period, the unhedged portfolio lost about 350,000. The graph also shows that the portfolio created by holding the stocks and buying 52 stock contracts. In our analysis of the risk minimizing hedge, we found that the trader could minimize risk by selling 52 future contracts. Buying 52 contracts doubled the systematic risk. Yeah, we know that. The new portfolio of stock plus a long position of 52 contracts increases the sensitivity of the portfolio to swings in the stock market. Okay, in effect, holding the stock portfolio and buying stock index futures simulates more than 100% investment in the stock. Well, that's clear. So a little common sense would say, yeah, I'm going to just double up. Well, you could do the same thing. You can long options, create the same type of environment. So here we have this information. You can look at this, unhedged, hedged. In the bottom line here, stock index futures, investment manager will increase the overall sensitivity of the investment portfolio to change in the stock market. Not surprisingly then, the stock long futures portfolio lost more than the pure stock portfolio, as it should. As figure 8.4 shows, every move of the stock index long futures portfolio exaggerates the movement of the all stock portfolio. For the portfolio of stock plus a long position of 52 index futures, the terminal value is 9052. So he lost $1 million. It's only money. Lost 9.48% of its value and his job. However, as figure 8.4 shows, for periods when the stock price advanced, if you're bullish and you're right, you're going to make money. If you're bullish and the market goes against you, this magenta color is going to be negative. ×2. Risk reward. Brad Williams. Frugal Finance. More to come.